The biggest misconception in trading is that scalping is about speed. It's actually about probability. Successful scalpers trade for high win rates, not huge reward-to-risk ratios. Scalping is the art of taking a quick profit from a single leg of market movement. Unlike swing trading, where you hold through pullbacks, a scalper exits as soon as the initial momentum pauses. In the price action methodology, scalping relies heavily on reading the immediate context of the last few bars. You are looking for a move that is virtually certain to continue for at least a few more ticks or points. Because scalpers take quick profits, the reward-to-risk ratio is often 1-to-1 or even slightly worse. To be profitable, your math dictates that you must maintain a high win rate, typically above 60%. The first and most common environment for scalping is the trading range. In a range, the market lacks strong momentum, so swinging for large targets is a losing strategy. In a trading range, the strategy is BLSHS, buy low, sell high, and scalp. We look for reversals at the edges of the range rather than breakouts. When price reaches the top of a range, traders expect a failure. A strong bear reversal bar here is a high probability scalp setup to the downside. We enter on a stop below that bar. Conversely, at the bottom, we look for a strong bull reversal bar. The target is usually a quick test of the middle of the range or a previous minor pivot point. Limit orders are also crucial for advanced scalpers in ranges. They fade breakouts, betting that the breakout will fail. However, for most traders, entering on stop orders after a signal bar confirms the reversal is safer. Now, let's look at scalping in trends. Strong trends are rare, but they offer the easiest scalps. Here, we never fade the move. We look to enter on pullbacks. In a strong bull trend, we wait for a pause or a small pullback. The high 1 or high 2 setup is the gold standard. We are buying the resumption of the trend. A high 1 is the first time the price goes above a prior bar's high during a pullback. In a very strong spike, you can take the high 1. In a weaker channel, wait for a high 2 for higher probability. The stop loss for a trend scalp is below the signal bar or the most recent major high or low. Because we are scalping, if the trade doesn't go immediately, the premise might be wrong. Another powerful scalp is the breakout mode setup. This happens when the market transitions from a range to a trend with a massive trend bar. When you see a large bar closing on its high breaking out of resistance, the probability of follow-through is high. Scalpers enter at the market or on a stop above that breakout bar. The target for a breakout scalp is often a measured move based on the size of the range or the size of the breakout bar itself. Scalpers take profit at these specific mathematical projections. However, beware of buying weak breakouts. If the breakout bar has a large tail on top or the follow-up bar is a doji, the breakout is likely to fail. This becomes a trap. This is where scalping requires intense focus. If that breakout fails, aggressive scalpers will reverse their position and sell, betting on the market falling back into the range. Let's discuss the specific setup of the wedge reversal. A wedge is 3 pushes in a direction. It often signals exhaustion and is a prime scalping location. When you identify a wedge top, you are looking for a scalp short. The target is usually the start of the wedge or a test of the moving average. It's a quick counter-trend trade. Crucially, scalping setups are negated if the signal bar is poor. If you see a wedge top, but the signal bar is a strong green bar, do not sell. Wait for a bear bar to close. Position management in scalping is distinct. Often, you exit a portion of your trade at a fixed profit target, perhaps 1 or 2 times the average bar size, and move stops to break even. This quick-out approach protects your win rate. Remember, in scalping, time is also a stop loss. If the market stalls for 3 to 5 bars after your entry, exit the trade. A common mistake beginners make is trying to scalp in the middle of a trading range. This is the noise area. The probability here is 50-50, which is death for a scalper. Only trade the extremes of the range or clear trend pullbacks. Avoid the barbed wire patterns where dojis overlap each other significantly. Let's review this second entry concept again, as it is vital. A first reversal attempt often fails. If the market tries to reverse a second time and holds, the probability of a successful scalp doubles. In a bear trend, look for a low 1, first pullback, then a resumption, then a low 2. The low 2 is the money trade for scalpers because trapped bulls will exit, driving price down. Scalping requires you to accept that you will miss the big move sometimes. You might exit with 4 ticks of profit, only to watch the market run for 50 ticks. Do not chase it. Re-entering simply because you missed out is an emotional trade, not a setup. Wait for the next valid pullback or consolidation. Comparing scalping to swing trading. Swing traders need a 40% win rate because they aim for 2:1 reward/risk. Scalpers need 60 to 70% because they aim for 1:1. Which style fits you? If you prefer high activity, quick decisions, and hate holding trades overnight or through deep pullbacks, price action scalping is your path. However, it requires the most screen time and focus. You cannot scalp passively. You must read every bar close to gauge the shifting probability. Start by mastering the high 2/low 2 in trends and the fade at range extremes. Master these 2 setups before attempting anything else. Master the setup, trust the probability, and take the profit quickly.